This is a clip from Keith's recent visit to the Real Wealth Show. Don't forget to hit like.
Our guest today has an investing mantra. He asks himself and others, what's your return on time? One doesn't simply want more income, he says. The ultimate goal is to live a great life as the outcome. I'm Kathy Fettke, and welcome to the Real Wealth Show. Keith Weinhold began investing in Anchorage, Alaska with a fourplex. He lived in one unit and rented out the other three. Since 2002, he has owned income-producing real estate in the U.S. and Latin America, 20 years now as an investor. And he says wealth is not acquired simply by putting one's money to work either. Few people know that. He says one acquires wealth by ethically employing other people's money, or OPM. And Keith is here on the Real Wealth Show to explain that to us. So Keith, welcome back. It's great to have you here.
Kathy, thanks so much for having me back. It's been a few years.
It has, and this is really good timing to have you here because these are unprecedented times, and I'm just so curious about how you're handling it and what you're seeing out there.
Yeah, there are so many aberrations in the general economy. For example, we've had 2 consecutive quarters of GDP contraction, which is a classic recession signal, but yet people still can't decide whether we're currently in a recession or not. And then there are probably even more unusual aberrations with the housing market. Is the housing market healthy? Is it unhealthy? And I think a whole lot of it really depends on who you are.
It is confusing because with the 2 quarters of negative GDP, we also had the highest job growth at 520,000 new jobs or something, a lot, when the average had been about 195,000 new jobs per month prior to 2020. So it's hard to imagine a recession with that much job growth.
Yeah, you're 100% right. That's just a great example of an economic aberration. We have seen, really a lot of these big tech companies, Kathy, that make a lot of the headlines, like Meta, which is a parent company of Facebook, and Microsoft and Netflix. They have either cut their staff or they have really slowed their hiring. And they're the big companies that make a lot of headlines. But with what we're seeing in some of the latest jobs report is all kinds of other economic sectors, from hospitality to manufacturing. They are hiring people. And with all this hiring and these strong jobs numbers and a 3.5% unemployment rate, some people say, oh, wait a second, how in the heck can we really be in a recession? And some people don't realize that it's actually human beings that sit around and decide officially whether we're in a recession or not. It's the NBER, the National Bureau of Economic Research. Yeah, like this is some sort of judge sport, like Olympic figure skating or something. Human beings actually sit around sometimes months or even years after the fact, and then they go back and say, yeah, that actually was a recession or was not a recession in 2022.
So maybe we won't know for a few years.
Right. Yeah, we don't really know. Aberrations certainly extend to the housing market, like I've touched on previously. And, I think I really have interesting news. Like, if someone doesn't know what's happened with the housing market and they haven't checked in on it for 3 years and they come back to today, what I actually like to tell people, Kathy, is that the probability of a housing crash is 100% certain. 100% certain. And maybe some people are like, well, what are you talking about? Are you clairvoyant or something? How could you say that anything like that is 100% certain? And that is because the housing crash, it already happened. This era's housing crash occurred in April of 2020. It was not a housing price crash. It was a housing supply crash. April of 2020 was that inflection point where the available units of housing failed to make its seasonal rebound, and it continued to plummet down, down, down. So to take a look at the data, to tell you what I'm talking about with this housing supply crash that took place, I like to look at the Fred data, and that shows us that the active listing count has been about 1.5 million, just per this particular measure that I'm talking about here. And that is currently about 600,000 available units of supply. So that's the 60% housing supply crash that I'm talking about. So it's this paltry supply, this dearth of supply is really what has driven so much of the behavior in the housing market, including the torrid price run-up. So yes, the probability of a crash is 100%. That's because it already happened, a housing supply crash, which is really a hedge against a price crash.
That's so true. And it's so important that people read the article and not just look at the headline of these news stories. I just had a talk with my news writer for my other podcast, Real Estate News, because she put some data in there that she was seeing elsewhere. And it was like inventory's up 30%. And, that can be misleading. And people can think, oh no, the market's getting flooded with housing just like in 2009 and nobody wants it. It couldn't be more opposite. And I said, no, we got to dive in a little deeper into the realtor.com data that they track the inventory pretty regularly. And literally houses are selling 1 day longer than they did a year ago. And
Right.
A year ago, they were selling like that. And inventory is not anywhere near where it needs to be because people are staying in their homes longer. They're locked into these incredibly low interest rates. Why would they ever leave? So when you see sales plummeting, it's like, nobody wants to buy houses. No. There's just not much to buy.
Yeah, there's just not much to buy. So with the example I gave with 1.5 million units of available supply historically, I let you know that there are about 600,000 units now by that measure. If that will go from 600,000 units up to 660,000 units, well, that's still a gross undersupply, but you could still say supply is up 10% in say 1 year or something. And people get the wrong idea because we're so far from having a balanced housing market.